Hello, I'd like to welcome everybody to the October 19th of 2022 Town Hall for the Aul Financial Group. We want to thank everybody that is here in person, listening to the webinar as we present it, and all of those that will listen to it later. I'm going to start out with a few dates, and I'll probably come back to it during my time frame when I'm allowed to speak, but let's go from here. First, we have had calls. Blue Leaf was an aggregating service that we had used for a very long time. But because of the fact that the amounts that were being reported to clients were incorrect, we stopped doing the Blue Leaf weekly reports on September the 15th of this year. We notified everybody on August the 15th that it was going to happen. If you have any questions around that, please contact David Brandon here in the office. We're using a new service called e-money. David can help set you up on that so that you're logged in. You can aggregate some of your things if that's something that you would choose to do. But we just had way too many problems with the results as far as gains and losses and the amounts in Blue Leaf, that we felt that we could not continue to put out false information on a weekly basis. So again, that was stopped on September the 15th of this year. A couple dates to put into your calendar. One, on November the 4th, we will be having an open house here at the office. That open house will not have a speaker, but I will have tickets to give to people that allow them the opportunity to win tickets to go with myself or Mel to the show Wicked at the Fox Theater. If you've never seen Wicked, it is a fantastic show. So we'll go from that. On November the 9th, our new clients and those that have referred clients through the year, and again, we thank you for that we have a dinner for our new clients on November the 9th. You should have received an invitation for that. We also have made the decision that the week between Christmas and New Year, there will not be anybody in the office. So if you have any year-end planning that you want to get done, please contact us before the Christmas break. And then the last thing, we contact clients that are in a Roth conversion mode, that they have been people that felt that Roth conversions was going to be advantageous for them. So we look at it and say, if your accounts are down and you look at it and say it might make sense to make a conversion in this fourth quarter, please give me a call. Those have to be done right after the Thanksgiving break. They do not guarantee them if they come later in the month of December. We also are contacting people on their required minimum distributions. We try to get those all done by the end of November, if possible, first week of December, because again, they do not guarantee it, and we don't want that 50% penalty. So if you fall in any of those categories, please don't hesitate. Contact the office, ask Miss Stacy, ask for an appointment. Let's come in. If Roth conversions is what you want to talk about, great. RMDs, great. Just normal conversations, we're okay with that too. Again, with that client referral dinner, I want to thank everybody that's referred people to us this year. It's helped us grow exponentially, and we just really appreciate it when people refer people like themselves to just continue to make the family here at the Aul Financial Group much larger. Again, thank you for your referrals. And I'm going to sit here and go, Deanna, should I go ahead and go ladies first, or do you want Mel to go first?
Oh, I'm happy to let Mel go first. You almost always let me go first, but it doesn't matter.
That's why I'm open to Mel going first. So Mel.
Don't steal my thunder, Mel. I already told you what I was planning on talking about.
I know, that's why I'm going to talk about, no. I was about ready to let you hear one coming from you. Age before beauty. I've heard it before. Okay.
You have the floor. Go ahead.
Thank you.
You're welcome.
So I have a little bit of a different concept for tonight. And it's not really that new. We talk about the right tool for the job a lot when we are putting together planning. But there's a couple of new things that are on the market today that are quite phenomenal. I'm not going to go into the name of the companies, or I'm just going to kind of give you a conceptual look at 3 different choices. When we are choosing what to do, we think it is very important to find out what results we're looking for. What is the primary focus of the next step? One step might be that we're concerned about long-term care or legacy. But we can't use life insurance for one reason or another. What do? How do you cover long-term care if nobody will give you a policy, or we can't get a life insurance policy that will double for long-term care? There's a product from an A-rated company out there right now that is unique. And it essentially works this way. You take a piece of money and put it in. I'll just make up an example. It could be 100,000 or 1 million. It's your choice. It can be IRA money or not. That's not relevant. The first thing they're going to do is give you a what we call a funny money 15% bonus. Okay, we have our real value account and our extended benefit account. So I put in 100, and over here I've got 100, and over here I got 115. This product has a fee, and it's not one of the lighter fees either. If you do this particular rider, we're probably looking at somewhere in the neighborhood of 2.1 to 2.2% fees, which is higher than just about anything else that we would even consider doing. But here's how it works. That 115 based on our 100, if the indexes that we're following on the real money make 4%, it actually would earn 10. Okay, and this locks in on a regular basis, whether it's 1 year, 2 years, or 5 years. Well, that can be determined. But if there were a 4% gain in the index, my 100 would turn into 110 real money. Okay, but my benefit account would grow twice that much. So my 115 would grow by 20%. I now have over $125,000. And this continues on a regular basis. So it sounds phenomenal, I know, but you're paying a fee for this leveraged growth, and the fee comes out of the 110. So our actual physical growth in the account might be reduced more than it would in some other account. But my purpose here was legacy and long-term care. If we continue this type of roll up, and if it makes 10, then you get 20. If it makes 20, you get 40. I mean, it's not a limited or structured system where you can't get the full benefit. But if we took 100, I'll make up numbers. Let's say that our 100 in real life turned into 140 over a period of time, but our benefit account is 250. Here's what happens. If you need long-term care, they will pay you the benefit account out over a 7-year period to help cover your long-term care. If you pass away never having used this account, your heirs can get all of that benefit account on a 5-year payout. And of course, you always have the ability to withdraw percentages from the account yourself. So if long-term care and or legacy is an item that you're interested in, it's a really good way to build up a big nest egg over. If we left that thing in there 10 years, it might be, that 100 might be $300,000-$400,000 worth of benefit. So it could be quite substantial over time. So that was if I was looking for legacy or long-term care, and I can't use other tools. Okay, what if I wanted just accelerated growth? I want the maximum growth, and I don't want to pay huge fees, and I don't want all these other benefits at all. I'm just looking for the growth. Well, same company, but without the benefit structures. Take all the extras off, lower the fee down to about 0.75 currently. It's a much lower fee, or a little bit more, depending on which index you want to use. But the growth potential is just phenomenal on that particular product based on past performance. Always got to throw that caveat in there. Past performance doesn't guarantee the future, but it is a fixed index product where we can't have a negative return due to the market returns, and the upside is quite phenomenal. Well, I don't really want the accumulation and all this other stuff, Grace. I'm mainly interested in filling a gap for income. Well, then I switched companies to another name brand company that's A+ rated. You would know if I sang their jingle for you here. Essentially, it has one of the best income production products on the market today. So the point of the conversation is this: if you know you're looking for a specific thing, and you want AUM, you want assets under management, and you want complete liquidity, and you want to be aggressive or conservative, we have that. We have the ability to structure. You want dividends, fine. You want a high interest rate with limited liabilities. Okay, great. We have that too. But if you're interested in, I can't lose the money, I don't have to pay exorbitant fees, and I primarily am interested in accelerated growth with no risk to principal, company A. I want maximum income for myself or my spouse, company B. I want long-term care coverage without having to give away my money or pay huge prices for long-term care insurance, or I can't get other things that might work even better. This is my only option to have extra money from someone else to pay for my long-term care. Or I really just want the biggest legacy I can for my kids. Those are three distinctly different products that all have one particular thing in common. You can't lose your money in times like this due to the market. These 10, 20, 25% drops in the market, the primary effect on these products is, okay, I didn't make anything this year. That's a pretty strong benefit to be mixed in with your other assets, which are managed for growth and liquidity. So I just wanted to really kind of hit on the fact that, you know, if you want to drive a nail in a wall, a screwdriver is probably not the best tool. Still a great tool, very functional, does a lot of things, but you want a hammer, and you want the right kind of hammer because you've determined you have a particular job that needs to be done. Picking the product for your particular portfolio is exactly the same concept. Figure out what you want, then get the right tool. So that's mine for tonight.
All righty. Thank you, Mel. Deanna, do you want me to stop the share?
Yeah, would you? That'd be great.
All righty. We're going to go ahead and turn this next segment over to Miss Deanna.
Okay. Well, we've shown you roller coaster pictures like this before. Can you guys see what I have on my screen?
Yes.
Yeah. There's a reason why you hire us. And it's to help you to buffer out some of the noise and focus on the things that we can control. And we're certainly in a period of volatility, and they're talking about, you know, is this a bear or a recession? You know, where's the bottom? You know, we don't know where we're at. We know that we're tumbling down this hill right here somewhere. We can never call the bottom until we look back. But are you utilizing this market for the opportunities that abound? We don't want to waste a good market downturn. And what are some of the things that you could be doing during a market downturn so that you can participate in a strong market recovery? What's your market recovery plan? So one of the things that we do, as Mel mentioned, you know, it's the right tool for the job, right? And one of the biggest fears we hear folks talking about right now, also in addition to this market, is inflation. Oh my gosh, inflation is out of control. And well, it's one of the reasons why we participate in the market at all, is to protect your buying power. That's why we utilize markets and why we can't sit on the sidelines in cash or in CDs, or you would go broke safely. So we must participate in some of that market exposure if we're trying to stay ahead of inflation. If you're one of those fortunate few that have enough that you can sit in cash, and with the inflation pressure will never run out of money, you might not need to have a lot of equity exposure, but that's going to be determined by the individual as to how much equity exposure we need. And now's the time possibly to tighten up your positions. Do you have money sitting on the sidelines? Trying to time the market is a loser's game. We've proven that statistically over and over again. What we do know is markets always go up. That's this picture here. Markets always go up. I realize this is only the last 2 decades, but if you look at another picture here, this goes back to 1966, and it shows the bear markets throughout history. Stocks spend a lot more time in bull markets than they do in bear markets. So we don't know how long this one will last, but when they do recover, they recover fast, strong, and also with a big bounce. And so if you're waiting to move money into the market, don't wait until we've solidified or determined where the bottom is. Now, I'm not suggesting that you overexpose into markets. One of the things you have to understand that we do with our clients is income planning. So what are your income and cash and liquidity needs first? The dollars that we're allocating to markets, those are longer term dollars. But if you're waiting to reallocate into those markets, I'm suggesting that you not wait. You take advantage of some of these opportunities with very high quality companies. Could they still go down more? Possibly, yeah. But we don't want to wait until we've missed that bottom, and trying to time it is a loser's game. This is another image of recoveries after bear markets, and this one goes all the way back to 1926. Again, you'll see from this image that the bull markets are stronger than the bear markets, but they don't feel like it. We get very complacent during bull markets. It's the bear markets where we make a lot of mistakes. So we're trying to prevent those costly mistakes of moving into cash or staying in cash or staying too moderate on some of those long-term dollars. How much you need in equities, again, that's going to be by individual. Difficulties in trying to time the market. This was interesting. You know, this is our lane, this one on the far right. We're not trying to get the best days, and we're not trying to avoid the worst days. We're trying to ride that middle. If you stay fully invested in the market, which most of our clients never do because we need to have some cash, right? You have to have cash. But if you exclude the worst days, who can time that? Your return since 1930, look at that. That's crazy. No one can time the market to do that. But if you miss the best days, that's a significant difference of only getting 28%. That's a significant difference if you miss those big recovery days. And that's why we want to keep that equity exposure, keep you invested. And for your longer term dollars, particularly your Roth accounts, those are the ones that we want to be more aggressively allocated to equities. So what are your key opportunities during a market downturn? Have you stopped contributing to your accounts? If you're still in accumulation mode, if you're still accumulating, make sure you continue those contributions. And you might consider contributing them to the Roth side if that's a fit for you. If we've done tax efficiency planning for you, we may have determined that that's a better fit for you, but have that conversation, make those contributions, buy into quality assets while they're on sale. Always consider Roth conversions during a market decline. We do these routine with our clients throughout the year, and particularly in the fourth quarter is when we're determining how much more wiggle room we might have within a threshold. But in a market downturn, part of that Roth conversion is subsidized. I loved this quote that I came across. The government subsidized losses in traditional IRA and 401k accounts. We've told you this, a traditional tax deferred account is a partnership. It's a bad partnership between the owner and the state and federal government. How much of your IRA and 401k is yours? Maybe about 70% of that, depending on your tax bracket. Well, if the account value fell, and now you only own 70% of a small amount. Look at this. While the account lost $25,000, the account owner only lost $17,500. The federal and state government subsidized $7,500 of that loss. It's a great time to be doing Roth conversions. And then all of that recovery and bounce is in the Roth, and that's yours now. You don't have to pay another nickel on that to the IRS. So Roth conversions in a down market is a great opportunity. Always consider your cash flow needs. We don't want to try and make a buck or gamble in the market if we're going to turn right around and take dollars out of that account. That makes 0 sense. So consider your cash flow needs. If there is excess cash, that's the cash that could definitely be taking advantage of these down markets and potentially be going back into those quality equities. Rebalance. We do this regularly for our clients. We want to make sure that the ratio of safety to risk assets, stable to growth assets is in line with your particular risk profile, your cash flow needs, your income needs. Now's the time to be shoring that up. For some folks who have been sitting on the sidelines waiting to change advisors, oh, I'm just going to wait till everything smooths out and then I'll talk to an advisor and make a change. Don't do that. You need to be tightening this up now. Take advantage of the down market and get into quality positions so that when the market recovery does occur, you're going to participate in all of that. And you're going to be allocated for your risk profile, not the one that may have suited you 10 years ago that's got you in this down space now. So make sure that you're ready and positioned strongly for when the market does recover. Tax loss harvesting, that's another great opportunity right now. Again, on the one hand, we're telling you, you don't sell equities and when the markets are down. Well, you're not staying out of the market if you're doing tax loss harvesting and selling some of those dogs that no longer work for you and instead buying into quality asset positions while everything's on sale. And then when you get the market recovery, you get the advantage of those carry loss forwards. So there's an opportunity with tax loss harvesting too, but do not try to do that on your own. We have a great resident tax expert right here in the office named Stephen Aul, and he'll be talking to you next. And that guy's the guy you want to crunch those numbers for you. So consider equity exposure. Consider tightening up your positions. Consider getting rid of some of those loose dogs in your portfolio so that you can have a market recovery plan within your allocation strategy. So that's what I had for you guys.
Thank you very much, Miss Deanna. I don't normally share a screen, but I do have one that I do want to share today. Well, we look at it to the point where they say over time, the stock market will average 8 to 10%. And we get the question all the time, well, it didn't do 8% or didn't do 10%. And we look at it and said, that's an average over time. So I'm going to go down to a couple charts that they talked about in this one. Those are your returns of the S&P 500 from 1977 to 1999, you know, the tech era. During that time frame, we look at it, there was one return at 9.97 that was in that 8 to 10% category. We also look at those days, there were only 3 negative years from the late 70s to 1999. Why would something like that happen? We remember when the 401k came into place in the late 80s. So therefore, we had buyers coming into the market in droves. Not everybody had a brokerage account. Mutual funds became a lot more acceptable. 401ks, money was pouring into the market. What happens to markets when there are more buyers than sellers? You have a market increase. And that is what drove the 90s. I get a lot of people that come back in and said, do we ever expect to see the returns of the 80s and 90s again? I'm going to say probably not over a long period of time. So let's look at what's happened in the last 22 years. In the last 22 years, we've had some very large market declines. Most of us that are on this call or are listening to this call have experienced all of these. Some of our children have only experienced the current one. You know, the millennials are finding out markets don't just go in a positive direction. They find out that they are negative also. But we'll look in here again, there's not a lot in that 8 to 10% area. and what's happened in the last 4 to 5 years. Those baby boomers that were buying into the market are now turning 72, and they are now what we call forced sellers because of what we call required minimum distributions. There was a slight break for that. We look at this again. We have a lot of up years and some very heavy down years. As Mel was talking about it with the fixed indexed, one of the things that I think is very advantageous is some of the fixed indexed annuities that are out there today. You can keep a simple index like the S&P 500. And a year or two ago, they had 2 to 3% caps. They weren't worth us talking to you all about. Many of those have a lot larger caps. We also look at it to the fact that there are a lot of the indexes out there today that don't cap the upside, but they still have that 0 as the bottom. You know, and we look at it last year, we moved a lot of money out of the quote invested side, put it into the fixed index annuity with what we called a return of premium. The main reason for doing that was the fall of bond prices. When interest rates rise, bond values are going to decrease. One of the things that you can expect when we come back in, I think Miss Deanna's first chart covered that well. Now could be a very good time to start taking that free withdrawal from some of those fixed index annuities to reinvest back into the market. Because remember, when is the best time to buy in the market? When markets are down. But it's very difficult to do. It's usually, I want to wait till this pool gets warmer. I'm going to keep sticking my toe in. And we don't get to actually the investment side until the water's warm enough. The problem is that we could be heading towards another negative at that point. We currently don't have a clue when the bottom of the markets is. You know, a couple days up does not make a market recovery. I still think we have the uncertainty of the midterm election. We still have uncertainty of what's going on with Russia and Ukraine and inflation. One of the things that I do want to mention to people, with the increase in Social Security this year, if we were looking at saying we're going to delay 1 more year to take your Social Security, with the 8% increase that you got for delaying the Social Security, plus the almost 9% increase that you're getting from Social Security, we could get that exact same amount in January. We might not have to wait another year to get the amount that we had planned for. So Social Security planning will be important over these next 3 to 4 months. So don't be surprised if we talk to you about Social Security planning when you come into the office. Again, let me just touch those dates real quick. November the 4th, open house here at the office. We will be giving a door prize to the Fox Theater's Broadway showing of Wicked. It's not till April of next year. A couple different dates we'd let you pick. We do have the new client and client referral dinner on November the 9th. That is a Wednesday night. And again, if we have RMDs or you're thinking about Roth conversions, we need to get those done just right after the Thanksgiving break. So again, I want to say thank you for everybody for being on it here with us live. Thank you to those that are going to listen to it later. Please feel free to send this to other people. We are very open to that, and we would truly appreciate it. Again, thank you for being a part of the family.